After studying this module, we shall be able to first understand the need to analyze the causes and implications of economic crisis. Secondly, we learn how the global financial crisis unfolded. Thirdly, we'll understand the mechanism at work that resulted in the crisis. Then, we'll comprehend the role of financial intermediaries in causing and the spread of the crisis. Then we'll discuss and identify certain features inherent in the working of banks, for example, leverage, complexity of financial instruments and liquidity that shaped their role in the financial crisis. Then we'll discuss and study the policy measures adopted by the US Federal Reserve to overcome this crisis. And then we'll examine the process of recovery after the crisis. Any economic or financial crisis results in wide-scale economic devastation. The Great Depression of the 1930s had weakened economic havoc, causing prolonged and widespread unemployment and massive destruction of the wealth. But on a positive note, it provided ample scope for research into the factors responsible for such a situation. It also exposed the vulnerabilities inherent in working of an economy and brought the key role of government intervention in such situations to the center stage of economic discourse. Thus, valuable lessons can be drawn from the study of any crisis. The global financial crisis is one of the largest crises that has affected the world in recent times. According to Krugman, in the year 2008, like disease that have become resistant to antibiotics, the economic maladies that caused the Great Depression are making a comeback. The global financial crisis was triggered by a decline in housing prices in the US during 2006-07. As it unfolded, the crisis exposed the fragility of the financial system and soon engulfed most banks and financial institutions. The financial institutions' ability to lend declined sharply, and as a result, the cost of borrowing soared while investment demand plummeted. A crucial link between savings and investment was ruptured, resulting in reduced aggregate expenditure and hence sharp decline in economic activity. The present module attempts to explain how this crisis originated, its adverse effect, and what policy measures were taken to counter its negative impact on income and employment. Now we are going to discuss the crisis. In 2006, housing prices in the US started declining. Policymakers anticipated that this would lead to a reduction in aggregate demand and growth. However, very few could foresee that this would have a substantial impact on the financial sector and results in a full-blown financial crisis. This is the basic crux of the factors leading to the onset of the crisis that forms the subject matter of this section. The prices of the houses in the US had started increasing in the early 2000s and then stabilized in 2006. Thereafter, towards the end of 2006 and in 2007, house prices started declining rapidly. Let us try to analyze why housing prices behaved in this manner. The prices started rising in 2000 due to rise in demand for houses. This increase in demand for houses was partly driven by prevailing low rates of interest owing to the easy money policy followed by the US Federal Chief Alan Greenspan. The low rates made housing loans attractive as mortgage rates were low. Also in the early 2000s, the dot-com stock market crash had shaken the economy. In its aftermath, the real estate sector seemed to offer a safer, more attractive investment option as compared to the stock market. Thus, house prices rose as the demand for houses was high. In addition, mortgage lenders were not reluctant to lend even to low net worth, risky borrowers referred to as subprime mortgages or simply subprimes. The subprimes had existed even during the 1990s, though these increased enormously in volume after 2000, particularly from mid-2000. Most economists viewed the rise in housing demand as a positive phenomena, as a natural commitment of a booming economy. But some economists like Robert Shiller warned that the rise in housing prices was a bubble that could soon burst. When the housing prices started declining in 2006, some borrowers realized that the value of mortgage they held was actually higher than the value of the houses they owned. These are termed underwater investment. It is now clear that the crisis was triggered with the fall in housing prices. However, its effects were enormous and they spread from the real estate sectors to all other sectors of the economy as well. To understand why this happened, it is crucial to examine the role of banks and related financial institutions in this process. So now we are going to discuss the role of banks and financial intermediaries. Banks are financial intermediaries that accept funds from those who have surplus cash to lend to those who wish to borrow from them. The world over, banks are required to meet certain stipulated norms laid down by the central banks of the countries in which they operate. Among the several stipulations, one is to maintain adequate capital. An adequate level of capital ensures that a bank can survive even in times when the value of its assets plunges. Capital adequacy norms are measures that act as a safeguard against the risk of bankruptcy. During the crisis, it was found that the banks actually had inadequate capital reserves. Also, the liabilities, for example, deposits of banks, were short term while their assets, for example, housing mortgages, were long term. This is commonly referred to as the problem of maturity mismatch. Due to this, the banks found themselves in a situation where they were both insolvent because of inadequate capital and illiquid, short on ready cash to meet liabilities. Since majority of banks and related financial institutions face similar incentives and face similar problems, this spread very soon from one institution to other and ultimately the whole financial system collapsed. In particular, the problems in banks arose along several factors discussed below. The very first is capital inadequacy and excessive leverage. A financial entity's leverage ratio may be defined as the ratio of capital to assets. Many banks had very high leverage ratios during the financial crisis. The banks and financial institutions, in pursuit of higher profit in an era of lower interest rates, increased their leverages. This added to the riskiness in their operations so much so that ultimately the higher risk resulted in collapse of the entire financial system. Various explanations have been put forward to explain the excessive risk-taking behavior of the banks. First, banks created new, innovative and complex financial instruments such as structured investment vehicle to escape the regulatory requirements of minimum capital ratio. Secondly, given the complex financial instruments, banks could have underestimated the risk involved. And thirdly, during the boom period, bankers were probably tempted to make the most of the financial innovations to earn more profit. The second reason is financial innovations. A new development in the financial intermediation activity during the 1990s and 2000 was securitization. In securitization, the returns on securities are based on bundle of assets such as loans or mortgages. It is a good way of diversifying risk. For instance, banks were able to take off mortgages from their balance sheets by selling them off to other banks or investors as mortgage-backed securities and raise funds in this process. However, such activities can be extremely risky, especially if underlying risks are not properly estimated. During the financial crisis, the rating agencies too miscalculated the risk associated with mortgage-based securities. When the housing prices fell drastically, the mortgages on which these securities were based went bad. Another aspect of the financial innovations was that it brought into existence a number of non-bank financial institutions, for example, investment banks that were not regulated by the Federal Bank, but essentially performed a similar function of financial intermediation. These have been referred to as parallel banking system or as the shadow banking system. While these entities also suffered from the problems of high risk taking and maturity mismatch, they were not regulated like banks. The third problem associated with is reliance on wholesale funding. Another development that took place in the financial market was availability of other source of finance apart from retail deposits, that is, savings and current bank accounts of individuals. The concept of wholesale funding became popular, wherein banks created short-term debt instruments, for example, mortgage-based securities, to raise funds from other banks and financial institutions. In this way, the banking system, indeed the larger financial system, became involved with a fairly similar pool of assets. The problem was that these assets mostly derived their values either directly or indirectly from the pool of housing mortgages, a chunk of which comprised subprime loans. Here, C is equal to the weakness of this system was exposed during the financial crisis. As banks, financial institutions and investors became concerned about the value of assets they held, with all the parties, including banks, attempting to simultaneously get rid of the assets, their prices plunged as there were hardly any takers. So banks found it hard to sell these assets and were often compelled to sell them at very lower prices known as fire sale prices. The development of this unregulated financial structure also contributed to the financial crisis. According to Krugman, in the year 2008, as the shadow banking system expanded to rival or even surpass conventional banking in importance, politicians and government officials should have realized that we were creating the kind of financial vulnerability that made Great Depression possible, and they should have responded by extending regulation and financial safety net to cover these new institutions. Based on these problems, the occurrence of the crisis can be summarized in terms of following two mechanisms that were at work. First, the crisis started when the housing prices started declining. Due to this, some mortgages turned bad. This implied high riskiness of banks' assets. At the same time, owing to high leverage, there was a sharp fall in the capital ratio of the banks. In order to escape from this situation, banks started selling their assets. But due to difficulties associated with valuation, in most cases, the assets had to be sold at very low, fire sale prices. This served to worsen banks' balance sheet, further reduce the capital ratio, and put more pressure on banks to sell their assets, resulting in further decline in asset prices. Second, due to the sheer complexity of financial instruments involved, for example, mortgage-based securities and derivatives based on these, it became difficult to assess the value of assets and cast doubts on banks' solvency. Accordingly, investors stopped lending to banks. So banks had a shortage of liquidity and actually faced the threat of bank runs. Due to the working of these mechanisms, the financial system had collapsed completely by September 2008. The financial crisis gradually turned into a macroeconomic crisis, resulting in loss in investors' confidence and a general rise in the cost of borrowing due to lack of funds or liquidity shortage, so that potential borrowers were unable to borrow. This resulted in widespread anxiety and uncertainty among economic targets and economic agents. It also resulted in a sharp fall in consumer spending. The fear of the global economy slipping into another Great Depression began looming large. Such a decrease in demand for goods can be explained by a significant leftward shift of the IS curve in the ISLM framework. In response to these adverse conditions, policy makers took several measures. They are discussed in the next section. So we start with the policy measures taken by the economists. As the crisis dealt a severe blow to the financial intermediaries, the immediate and most urgent policy measure attempted to strengthen the financial sector. A number of emergency measures were taken by the US government to reinforce confidence in financial institutions. For example, deposit insurance was raised from $1 lakh to $2 lakh per account. The government began to guarantee new debt issued by banks. The government put in place measures to make adequate liquidity available in the financial system, and a new program to clean up the banks was also introduced. All these collective measures were taken to restore sufficient flow of liquidity in the financial system. reduce bankruptcy and failure of banks and other financial institutions, as well as to stabilize the financial system. Both monetary and fiscal policies were used to achieve these objectives. Then we have another topic, that is conventional monetary policy. Interest rates in the US had been close to zero since 2008, so it could not have been reduced further to ease the liquidity problems. Such a situation where interest rates are extremely low or close to zero is described as liquidity trap. Recall from our past discussion in the earlier modules on the ISLM framework that when the economy is in liquidity trap, people are indifferent between holding money and bonds, so that monetary policy becomes ineffective. Under normal circumstances, the money demand curve is downward sloping, and an increase in money supply reduces the interest rates as shown in figure. In case a liquidity trap occurs at the zero rate of interest, as in the case of US, the money demand function becomes horizontal and is aligned with the horizontal axis as shown in figure. In this case, any increase in money supply is held by the public with no consequent reduction in interest rates. Interest rates do not fall further as they are already zero, as shown in these figures diagrammatically in a figure manner. This was the situation in the US during the financial crisis. The interest rate on treasury bills was zero and the US economy was in a liquidity trap. In this case, conventional monetary policy was completely ineffective in receiving aggregate demand and output. So then the US thought of fiscal policy and quantitative easing. Thus, what about the role of fiscal policy when the economy is in liquidity trap? Once again, recall from our past discussion in the earlier modules that fiscal policy is very effective in reviving aggregate demand and output under such conditions where there is no crowding out. In fact, the role of fiscal policy in the US crisis brought back Keynesian economies and is very important during the Great Depression period to the very heart of policy and academic discourse. However, fiscal policy that was discussed separately in some of the previous modules too has limitations. Under normal circumstances, a one-time fiscal stimulus may be sufficient for increasing the level of output. But in a deep recession, a one-time increase in government expenditure may fail to revive business and consumer confidence and have relatively small impact on aggregate demand and output. In such cases, the government will have to continuously incur several rounds of expenditure hikes to boost the economic activity. Obviously, this means that government will have to run higher deficit and look for ways to finance it. It may have to borrow, which would result in higher price debt. In the long run, the rising public debt and its cost of debt servicing may make it unsustainable to rely solely on fiscal policy. In case of the US, the policy makers also adopted certain unconventional monetary measures known as quantitative easing. This involves US Federal Reserve doing something rather unusual. It started buying up financial assets, for example, securitized debt instruments issued by the private financial sector. This was done to stabilize and restore confidence in the financial markets. The US Fed took on its books balance sheet toxic assets that all other economic agents were extremely reluctant to hold at that time. Since this was a departure from the Fed's standard practice of holding government securities, this was an unconventional monetary policy response put in place due to the failure of traditional monetary channels. Then we have recovery after the crisis. After the housing bubble burst, the US economy experienced the worst ever financial crisis. As the US economy in particular and the world economy in general recovered after the crisis, there is little doubt that there have been signs of recovery, but the pace has been quite low. Some economists believe slow recovery is also a sign that the natural level of output, that is long run equilibrium output, itself has declined after crisis. The banking and financial collapse during the crisis has made the financial regulators alert. So, all new developments such as new products, innovations, new kinds of financial intermediations, as well as the entire financial market are under close scrutiny to prevent any further instability. While more effective regulation is currently being viewed as beneficial for the economy, it also adds to the cost of financial intermediation for borrowers and lenders. This may have contributed to the decline in the natural level output. The unemployment rate in US during 2011 was around 9%, while the pre-crisis estimates put at about 6% the natural rate of employment. It is now clear that such a large increase in unemployment cannot be attributed to supply side factors alone. The lack of aggregate demand is equally responsible for the depth of the recession and the slow pace of recovery. The problem is compounded by the fact that monetary policy and fiscal policy have their limitations. Hence, the natural rate of output may not be easy to achieve. But over the time, the US economy is likely to be put on a higher growth pace as business and consumer confidence and aggregate demand picks up. The demand for goods and services, though low at present, would not remain so far long. The recovery is sure, but may take time to happen. A number of policy measures would have to be taken to ensure this, and the banking and financial system needs to be restructured. Owing to the crisis, there has been lower investment in housing, but with population growth, housing demand is likely to increase, so housing prices increase and real estate booms are bound to recur. Such situations have to be monitored carefully in the future. Now we are going to make a summary of what we have discussed so far. We have discussed our analysis with the definition of financial crisis. Financial crisis results in wide-scale economic devastation and loss of consumer investor confidence. The financial crisis has taken place because of the failure of the housing sector in the US. The global financial crisis is one of the largest crises to have affected the world in recent times. Then we have discussed the crisis was triggered by a decline in the housing prices in US during 2006 and 7. The crisis exposed the fragility of the financial system as it soon engulfed most banks and financial institutions. Then we have discussed that during the crisis, banks had inadequate capital reserves and suffered from serious problems of maturity mismatch. Then we have seen that many banks had very high leverage ratio and hence high risk during the financial crisis. Then we have seen that during the financial crisis, the rating agencies miscalculated the risk associated with complex financial instruments such as mortgage-based securities. Then, by September 2008, the financial crisis gradually turned into a macroeconomic crisis, resulting in loss in investor confidence, and there was a deep recession during the financial crisis. During the crisis, the interest rate on treasury bills had fallen to zero, and US economy was in a liquidity trap. So traditional monetary economic policy was ineffective. Then came expansionary fiscal policy that tried to boost economic activity that results in higher deficit and higher public debt. Then the US Fed resorted to unconventional monetary policy, or it took the help of quantitative easing, that is used by the US Fed as an unconventional monetary policy or unconventional method of raising finance. Then in the long run, public debt and the cost of debt servicing may make it expansionary fiscal policy unsustainable. So, the US government tried to do everything to put the US economy on the map. Now, the US economy is on the road to recovery, but the pace is very slow. The recovery is slow because the natural rate of output has declined after crisis. More effective financial regulations may be beneficial for the economy but adds to the cost of financial intermediation. The banking and financial system needs to be restructured. Recovery is sure but may take time to happen.